Welcome to the monthly view from the Edge for December 2021. I'm Fritz Folts, Chief Investment Strategist here at 3Edge, and I'm joined here once again today by Eric Biegeleisen, Director of Investment Research and Deputy Chief Investment Officer at 3Edge Asset Management. As we do each month, Eric and I will provide our firm's most recent outlook for the global capital markets, which is based upon a proprietary research model. Have a lot to cover today, so let's get started. As we move into the final weeks of December and make our way towards the end of 2021, U.S. equities remain close to all-time highs and by almost all measures significantly overvalued. In addition, performance continues to be driven primarily by the largest mega-cap technology stocks. Recently, inflation is becoming more and more of a concern in the markets, and the most recent report on the U.S. Consumer Price Index, CPI, showed a year-over-year increase of 6.8% in November, which is the fastest annual increase since 1982. This inflationary pressure is putting additional pressure on the Federal Reserve to tighten monetary policy. And in that vein, during his recent congressional testimony, Fed Chair Powell said that it was time to retire the use of the word transitory when referring to inflation. In addition, the world and the global markets have now been introduced to Omicron, yet another variant of the coronavirus. And early indications, very early indications, are that it may be more infectious, but perhaps at the same time, the virus may be somewhat less severe in terms of illness than other strains. But regardless, coronavirus continues to offer a degree of uncertainty in the global economy and therefore in the global markets as we head into the new year. And, clearly the virus is not finished with us yet. So let me bring Eric into the conversation and let's take a look at what our 3Edge model research is indicating here in the final month of 2021 and beyond. Eric, welcome back. And let's begin by looking at our 3Edge asset class matrix, and perhaps you could point out what may have changed since last month.
Great, thanks, Fritz. Yeah, so as you can see here, there are a number of changes going on from November into December. We'll get into the details for each asset class as we move on, but at a high level, what you can see, we're generally seeing this equities and commodities, so-called risk assets, being less attractive, while fixed income and cash have an improved outlook. So the model output is showing us a potential transition from a risk-on to a risk-off environment, which doesn't happen too often.
Excellent. So why don't we begin looking at the various global equity markets, starting with U.S. equities, which obviously have had very strong year-to-date performance. What are we seeing there now?
That's right. Yeah, U.S. equities continue to hover around their November highs and remain significantly overvalued by our measure. A recent widening in the high-yield credit spreads in the U.S. has somewhat negatively impacted the attractiveness of the U.S. equity market. And as you noted, Fritz, beyond retiring the word transitory in describing the inflationary pressures in the U.S., Fed Chair Powell also expressed support for a quicker taper of the Fed's monthly bond purchases than was laid out in November. So not surprisingly, Fed fund futures, which predict the timing of rate moves by the FOMC, indicate a higher probability for rate increases, with the first as soon as May 2022, as the Fed attempts to normalize their monetary policy. So Fed tightening is a potential risk to U.S. equities since the surge of liquidity in response to the pandemic likely provided much of the fuel for the stock market's 20-plus month run. We'll learn more after the December meeting on the 15th of this month. Any significant flattening of the yield curve measures that we calculate alongside further increases in inflation expectations that you touched on and continued widening in high yield credit spreads would also prove to be potential headwinds for U.S. equities.
Excellent. So now let's move outside the U.S. and consider the ex-U.S. equity markets, beginning with Japan.
Yeah, although Japanese equity markets remain relatively more attractive on a valuation basis, the flattening of our yield curve measures in Japan highlights risks to potential growth prospects for the Japanese economy and has therefore reduced the attractiveness of Japanese equities in the short to medium term.
Excellent. And now, so let's take a look at European equities. Certainly seen inflationary pressures really ratchet up in the Eurozone. I think having an increase in inflation that's higher than at any point since the founding of the European Union in 1993. What are we seeing there?
Yeah, well, with regard to our European equity outlook, you're right on that inflation pressures there are at all-time highs, and the ECB has already begun to taper its bond purchases. In addition, the widening of investment-grade credit spreads in the region has helped lower the attractiveness of the European equity markets. Momentum measures that previously benefited European equities have also faded, and the potential energy shortage in Europe this winter remains a key risk to the European economy, particularly if Russia takes measures to limit fuel supplies to Europe.
All right, and now let's travel to India. Take a look at the India equity markets. I mean, India has had a very strong year-to-date performance in their equity markets, and the projected growth rate, I think, in the Indian economy is somewhere over 8% when we're done with 2021. So what is the model seeing there?
Yeah, our outlook longer term in India is quite positive. The notch down we noted in the asset class matrix at the beginning may prove to be a short-term phenomenon due to, in large part, the recent widening of the TED spread in India. That is the difference between the interest rate that banks charge one another and the interest rate on short-term government debt, which has recently negatively impacted the attractiveness of Indian equities, though it tends to be a bit of a volatile indicator. But the Indian equity markets continue to benefit from positively sloped yield curve measures, relatively benign inflation, and attractive long-term prospects for growth.
Excellent. Let's shift gears now, look at Chinese equities, and they've really struggled here in 2021 and underperformed almost all the other ex-US equity markets. And one clear headwind has been the shakeout among those large real estate developers. And believe this past week it was reported that China Evergrande actually defaulted at least on a portion of their dollar-denominated debt. So what is the model indicating about the state of the Chinese equity markets at this point?
Yeah, it's not a great situation there. The widening of high yield credit spreads in China and quite frankly the US as well is negatively impacting Chinese equities more broadly. In addition, as you already noted, the continuing pressure among Chinese real estate development firms to service their debt, more importantly, the uncertainty surrounding how the Chinese government will ultimately respond to the situation clouds the outlook there. That said, the Chinese government did recently announce its intention to focus once again on generating economic growth in China,
Right.
which is a pivot away from the recent, more restrictive government economic policies we've seen. A concerted policy shift by the Chinese government could be a positive for Chinese equities that we'll be keeping a close eye on.
Excellent. All right, so let's shift from stocks to bonds. Take a look at the fixed income markets, which have struggled here thus far in 2021, but there's been a shift a wee bit here, maybe in the short term in terms of the model output. So what are we seeing there?
Yeah, well, the potential for continued inflationary pressure and the potential for interest rates to rise continues to pose a threat to both the level of income and the value of bond holdings.
Mhm.
Inflationary expectations continue to grow faster than nominal interest rates, meaning real interest rates are likely to remain quite negative and may continue to get even more so from here. That all said, there are increased prospects for stagflation. That is, slow growth alongside rising prices or inflation, which would benefit TIPS or the Treasury inflation protected securities market. Our model research identifies a heightened risk of stagflation given the broadening and persistence of these inflationary pressures we keep talking about, widening credit spreads, flattening yield curves, and the prospect for a potentially tighter Fed, more aggressive than the markets currently anticipate.
Excellent. So let's shift gears and look at real assets. And last week in the week in review, Steve and I once again discussed our seasons of the market chart and how we could be headed towards a period when real assets may be more attractive than bonds. But of course, the nuance there is the short term versus the longer term. So what is our model research indicating for real assets? Maybe touch on both gold and commodities.
Yeah, well, gold remains attractive from the model research standpoint, particularly on a long-term basis, and is supported by a continuation of the current negative real interest rate environment that we just touched on. That is, again, nominal rates, less inflation expectations. However, more aggressive monetary tightening by the world's major central banks may present a potential headwind to further upside for gold in the near term. In an environment like this, fiat currencies may be viewed more attractive relative to a physical asset like gold. So time will tell there. Same risk would apply to commodities too, though we lowered the outlook by one notch to commodities, due to the current environment of widening credit spreads and the prospect of an even tighter Fed than the market anticipates. Again, we'll learn more in the middle of this month. All that said, commodities remain relatively undervalued in our model research and potentially attractive over the longer term.
Excellent. So great. Well, thank you for getting us caught up with the highlights of our View from the Edge for December. If you'd like to view the full 3Edge View from the Edge newsletter for this month for December, you'll find that print version on our website at 3edgeam.com. So that will do it for Eric and for me and this month's edition of the 3Edge View from the Edge. We'll be back again early January of 2022. Meanwhile, Steve Cucchiaro and I will be back next week with our regularly scheduled 3Edge Week in Review. All of our videos are available on our 3Edge YouTube channel, as well as on our website, 3edgeam.com. So on behalf of Eric and everyone here at 3Edge, thanks for listening and see you next time.